Hello, and welcome to another edition of Stonewood Study Group. My name is Neil Wilding, COO here at Stonewood Financial, and this is one of my favorite things we do here at Stonewood. We have this format or forum for me and others here on the team to just kind of talk through what's going on in the industry. Um, Sometimes we'll use this to push out new software. Other times we'll just kind of talk sales ideas or advisor testimonials or case studies. Um, Other times, like today, it is really an application of new tools that we've launched and how advisors and members across the US are using software that we've developed. Today's topic is legacy done right. And with legacy done right, obviously you can see the play on words here is an extension of the new software that we put out earlier this year, Roth Done Right. And with Roth Done Right, what we're looking to do is look at IRA money and just see if it makes sense to take some of that IRA money and move it from the tax deferred side of the balance sheet to the tax-free side of the balance sheet. And it looks at things like taxes and IRMA and helps you be a more informed advisor as you work with your clients in the conversion process. And so legacy done right is obviously an extension of that. And with the term legacy, you should be thinking of IRA money that is going to the heirs, whether that's the kids or whoever it may be. If it is not going to be used for income, then it is going to be subject really to this great concept that I'm excited to push out. And like always, I like to introduce concepts through examples just to really start the conversation here. Um, with Legacy Done Right, I'm going to introduce that on this webinar. We're going to walk through it, but we're also pushing out a resource for all members. And we've developed a landing page and some resources for you, and I'll hit on that as we go here. But let's just start with that example. Like, who are we talking about here that makes sense for this Legacy Done Right concept? It's baby boomers with IRAs where they don't really need that income, and they know that a portion of that IRA is going to the kids or whoever may be, to heirs. And so let's look at this through the lens of a 65-year-old couple. Let's say they plan on retiring at age 70. They've got 1.5 million in their IRA, but you know what? Retirement is well funded for them. So yeah, they might use 2/3 of the IRA on themselves, or at least keep it in that might use it for income. Um, but there's a portion of it where they just know for sure not going to need it for me. And more people you talk to kind of fall into this boat. And so the first thing I want to do for this couple is use that Roth Done Right software. And I'm going to go in, I'm going to calculate the total taxes they would pay on that money as it's going through the RMD process, right? Because if it's legacy money, it's not going to be level income, right? It's going to go through the RMD process, which means that account is just going to grow up until the point where they reach an age where they have to start taking those RMDs. And then at that point, that's when, the taxes start kicking in. So I'm going to run my Roth Done Right software, and I'm going to look at what are the total taxes this couple would have to pay if they stay in the IRA. And what would the taxes be if they converted to a Roth IRA? And in this case, I'm going to consider a 5-year conversion. Now, as Roth Done Right does, it also brings IRMA and those surcharges that someone might have to pay if they have the income level that supports it. We're going to look at the IRMA that they might have to pay over their lifetime, and then if a Roth conversion would trigger any additional surcharges now. So, ran the report. And again, I'm not going to go into all of the inputs here to what drove these numbers. This is really just meant to spark conversation. So for this couple, let's just say that their current and projected income suggests that if they kept that IRA, they'd pay over $600,000 in taxes. They would also have to pay some IRMA surcharges, which means their retirement income levels are pretty high. And by the way, if you have a portion of your IRA that you know is going to not be used, that probably means that you have a pretty healthy base of retirement income, whether it's Social Security, maybe they've got some guaranteed income annuities that you've offered to them, maybe they have rental properties, whatever it may be, right? But if they're paying IRMA surcharges in retirement when the RMDs hit, it means that they have a healthy income, which to me is like hand in hand with this legacy, right? We're kind of dealing with the ideal client here. So the total taxes in IRMA that they'd have to pay just on that $500,000 would be over $700,000 over their lifetime. Now, if we go through the Roth conversion process, good news. Hey, we can get out the door for 128 on the taxes, and we can do so before IRMA becomes an issue. And so this tells me that later on, when the RMDs kind of clipped up, that's when the surcharges came in. So if we're able to convert before those are in play, then we're doing something pretty good here for this particular client. Again, all of these numbers are going to vary greatly based on your specific client, but I'm just using this for an example. So I ran my Roth Done Right analysis here for the 65-year-old couple. Certainly makes sense to have a conversion conversation. But if the wealth transfer is going to happen, right? If this is legacy money, and we are going to be going through, and there's a portion of the IRA that we know is going to heirs. Well, let's just think of it. Like the industry has told us time and time again, if we just leave that money in the IRA, talking heads everywhere, including us here at Stonewood, guilty as charged, are saying that's just not a good idea. In fact, many are saying that's about the worst financial instrument you can use to transfer wealth. Why? Well, the Secure Act significantly changed that, right? If we're a non-spousal IRA, inherited IRA, we got to pay that tax in 10 years now, where before we could spread it over our lifetime. So we got some real issues where that money needs to be taxed. Or when it gets taxed, it needs to be taxed in 10 years. It just has a lot of side effects with it. And heck, we're how many years into the Secure Act, and we're still trying to figure out how to apply some of the messy language inside the Secure Act. So anyway, long story short, IRAs not so good for transferring wealth. But you know what is? Life insurance, right? Like, in fact, life insurance, that's what it was built to do, right? Life insurance was designed to take and transfer wealth. And so why aren't we using it more? Well, let me give you some reasons to consider life insurance in the Roth conversion alternative, right? And by the way, I'm not like breaking news here. I'm sure many of you on the call, like, yeah, Neil, been there, done that. We've been doing that for 20 years, right? We're taking money that we don't use and repurposing that into life insurance. But I want you to think through two things here. Maybe one, you fall in a camp where, you know what, light bulb went off. Why haven't I been doing more of this? Or maybe you fall into another camp where, yeah, I know, but man, that life insurance can get messy. There's a lot of details. We can't just make broad generalizations here. And so the program we're going to have here today overcomes and helps in both of those manners. So why consider life insurance in the Roth conversion alternative conversation? One, legacy multiplier, right? Like we could take, and you're going to see this here in the example, but you could take a couple 100,000 and apply a 2 or 3x early on to the client. And so we're taking legacy assets and making them far more valuable on day one than they are now. And so, and you'll see how that plays out. Also, boy, here at Stonewood, we spend a lot of time talking about legislative risk. And if you've been to Innovate or if you've seen one of our online trainings, you know that we like to differentiate between a contract and an account, right? And so if we have money that's in an IRA, just like when I talked about when they changed the rules on stretch IRAs, you're subject to those new rules. Like they can change the rules anytime they want on an account. But on a contract, when they go and change the rules, well, then clients get grandfathered in. When you look at the 80s, when Tefra came into play, those rule changes, the clients that had those old life insurance policies that really drove the rule changes, they were grandfathered in because it was a contract. And so when we start looking at the gauge of protection, a Roth IRA does a great job in protecting against tax risk. But if we want to go the full gamut and look at uh, also protecting against legislative risk, life insurance not only is it fantastic in transferring wealth, it also does so in a way that minimizes legislative risk. And then, of course, what's the ultimate? If we have um, legacy money and we know that money is going to the kids, the ultimate decision driver of your decision should be which option maximizes the wealth that I'm passing on. Like, I don't care about all the variables. Just tell me that when I pass away and someone inherits my money, which method of wealth transfer is the best in terms of total wealth generated. So that's why you consider it, right? And so now let's get into that, and because it's not just as easy as, oh, okay, take your IRA and use that money and go buy life insurance. Conceptually, that's what we're doing. But there's a lot of variables, and that's why here at Stonewood we've spent really the last 6 months building out this sales process for you, and we're excited to launch it for you here today. Is we want to try and uncover every potential variable, anything that could go wrong. How do we, in advance, anticipate what could happen, and really just build unassailable plans here. And so when we look at it, the structure of the life insurance, there's a couple of different ways to go about it, right? We could just do a 5-pay. In that case, taking money out of the IRA, take a distribution from the IRA, pay the IRS, use what's left to fund 5 payments. And what's nice about that one is we're done quickly, right? It's the shortest amount of time that makes sense inside the life insurance contract, um, while maintaining the tax-free nature of the life insurance, but also minimizing legislative risk, right, and tax risk, right? The sooner we complete the conversion, the less risk we're going to have. The longer the conversion, the more variables that could come into play. And so a 5-pay can be, and we've been talking about 5-pays since we started looking at IRA money, right? And fully support, and we've got a way to show you exactly how to execute the 5-pay plan. Now, as we started talking about transferring IRA money to a life insurance contract, some of our members came to us and said, well, you know what? I like to spread it out over 10 years and do more of a 10-pay. Why? Well, because that way I can sell them a new fixed index annuity or even a 10-year MIGA, and then use the 10% free of that annuity to then fund the life insurance premium. And so I can have two new financial instruments that I've put in place for my client. And it's a nice clean way where we're still able to fund the life insurance. We're using a new annuity to do it. And it's still done in a relatively quick time frame of 10 years. And so let's dive into those a little bit here, right? Both of those sound pretty simple in concept, but there is a level of detail that's really important. And the Roth Done Right software is going to help more now today than you've ever had before, which is how much of that money, like let's just say we're in a 5-pay, right? And all right, I've got 500,000 and we're going to peel off 100,000 a year for the next 5 years. The thing is, in advance, we have to structure the life insurance. And so we have to tell the insurance company how much is going into the life insurance policy each year. And so we have to know, so that in essence is going to become fixed. So we need to know in advance how much money is going to be going to taxes and then how much is going to be left over for that life insurance. So Roth Done Right can actually work for that. It can actually tell us exactly what's going to be in that tax and IRMA budget. So if we're doing a 5-pay or 10-pay, you go into Roth Done Right, you run that report, and I'm that bottom line there, the convert to tax free, that tells you what the taxes are going to be based on the income assumptions you put into the software. That's your number. Like, that's your tax and IRMA budget right there. So you take your 128, and that's what goes into the structure here. So you know that you got the 128. Now I like to round it. So when you actually execute this, you might do 130 or maybe 135 just to be safe. But see, that number also accounts for the fact that taxes could have gone up, right? Because in the assumptions in the software, you can model a tax increase. It also accounts for IRMA. So if there are going to be IRMA surcharges realized because of the conversion, will account for it. Because the last thing you want is to put this plan in place and say, hey, listen, over the next 5 years, we're going to transition this, and we're just going to go and, hey, today you're at a 20% effective tax rate. And that means 80 grand's going to life insurance, 20 grand's going to taxes. But then when the bill comes due and you actually need 22, 23 grand, well, that's a surprise. And we want to avoid surprises. So let's go ahead and build that into advance, anticipate what can change, and be more precise in how we set this up front. And so I used my analysis here, right? I used the Roth Done Right for the 65-year-old client, and I went to a carrier that offers, and these have become more popular here in the last couple of years, these protection-focused IULs, right? Or even GUL, or maybe a survivorship policy. But what I'm looking for is a life insurance structure that isn't depending on the cash value to be there, right? Like, it's even in our worst case, we're still, or maybe in a very small growth rate, we still have plenty, right? And the protection focused IUL has done a good job of addressing that for our industry, and it's perfect for these legacy cases because we want to set it and forget it. We're going to set this up, and if we do 5-pay, 10-pay, we just want to know that we already have everything we need to execute this, and we don't want any surprises. So I went to one of the popular carriers here that provides protection-focused IUL, and I just did a 5-pay. And with the 5-pay option, again, that's 128 grand going to taxes, the rest going into to a 5-pay. In that case, if you wrote the insurance on the male, you'd be looking at $860,000 of legacy. If you wrote it on the wife, you cross over into 7 figures. So there's $1 million. And if you do like a survivorship type case, that's it's over $1 million as well. So that's kind of up to you all in structure and who's the who's the insured. But that's our case for a 5-pay. Now, what if we did the 10-pay idea? And I went out and I went to the same carrier and I said, well, what if we just paid and we had to pay the same amount of money in premium and taxes, but now it's spread over 10 years because I'm going to use an annuity and pull out the 10% free and fund that. Well, actually, the 10-pay is a lot less. It's only 666 or 784 or 854. But there should be an asterisk there. What do we have going on here? We use 2 financial instruments, right? What about the annuity? Is that annuity growing while we pull the money out? Yeah, right. If it's a MIGA, we know the fixed rate. If it's an FIA, it's probably between 0 and whatever a good credited rate for that particular contract has been. And so what if we assume some interest of that? In this case, like I think I assumed like a 5% growth rate. That gets you an extra $200,000 of interest. Well, that's like 4 more years of payment. And so your 10-pay, if you want to use that interest to buy more life insurance, and this is a predictable financial instrument where you can be confident in that interest, well, suddenly your 10-pay becomes a 14-pay. And you know what? If I went to that same carrier and did a 14-pay, now my death benefit kind of lines up, right? Where very similar values. In fact, you're getting a little bit more because we're working with more interest, right? So to speak. And so those are 2 extremely popular ways of going about this. You got the 5-pay, you got the 10-pay that becomes a 14-pay. But we also get to question, well, wait a minute, Neil, the way that I've been doing this is I got these clients that are in annuities. I can just trigger an income benefit and they don't really need the income. Let's just use that, the guaranteed income, to then fund the life insurance. Or maybe it's we've got new money, but instead of just buying an FIA and taking out the 10% withdrawal, you buy a new FIA with a guaranteed income rider, and we're going to spread that out over the lifetime and just take that guaranteed payment and use that to then buy the life insurance over time. Well, that works, right? And in this case, you could take $500,000 and put all $500,000 into the annuity, trigger the guaranteed income rider. We're going to liquidate that over time, and we're going to take those withdrawals and then use that withdrawal to then fund, from the IRA annuity to fund the life insurance. But you see, there's still a variable that's in play here. And I'm encouraging you, I think this is a great way to go about it. But do know that taxes, like if we're funding this over your lifetime, the tax policy of today can look very different. The tax policy in 10 years, 15 years, 20 years. And so we have to budget this properly. Well, good news is we can also use the Roth Done Right software, albeit in a different manner, to help tell us how this would work. And so now what I'm going to do is I'm going to go in and I'm going to change my example. And so instead of doing a 5 pay or 10 pay, I'm going to go more the life pay idea here. And I'm going to buy a new annuity with the 500,000. In this particular case, I was able to get about $40,000 of guaranteed income. Remember, I think this couple is 65, and I guess we're triggering the income right away. Whatever it is, there's 40,000 of guaranteed income here. In that case, the Roth Done Right software told me that the average tax and IRMA over this client's lifetime, again, we're taking into account taxes changing, we're taking into account IRMA surcharges, all of that. It represents just under 29%. Now, starting out, it might be lower, might get higher, but that's the average effective tax rate. And so we're going to use that to calculate our tax and IRMA budget, which means that you have what, $11,000 going to taxes, $29,000 going to the life pay. And in that case, you're actually able to buy a lot more life insurance. Why? Well, because what you're doing is you're offsetting the risk of living too long, right? Because what's the risk of doing a life pay into the life insurance contract? Well, you live to be 100 or live to be 95, and you end up paying more than you would have if you had just done a 5 pay or 14 pay. But see, you offset that risk with a guaranteed income rider, and suddenly it's neutralized to where now you know as long as you're alive, that rider is going to be kicking off paying your premium, and when you pass away, the income rider goes away, but then that's of course when the transfer of wealth happens. So a common question that comes up in all Roth conversions, regardless of whether it's legacy money or money that you're going to use for income or whatever it will be, is when will I break even? And that's why at Stonewood we pushed out a new addition to the Roth Done Right software, which is this break-even analysis. And so if I ran the break-even analysis on this case, this particular, again, don't get into the details, like run your own reports so you can see how this, I'm just trying to spark a conversation. But I do know that the general objection to a Roth conversion, regardless of purpose, is like, gosh, man, if I have to pay all that tax up front, when will I make it back? When will I make that money back? And so if we're just doing a Roth conversion, it might take some time. Like in this case, between age 78 and 79 is when you reach the break-even point where the Roth, if you passed away that year, the Roth was a better deal than the RMD, or the RMD path of the IRA, right? And I'm looking at total wealth generated there. But see, with life insurance, what do you get right up front? You get a death benefit, and it's got that multiple. So regardless of which way you're doing this, like if you're just doing writing it on the mail and doing like a 5 pay, you got like a 7-figure death benefit there. Now, at some point, the Roth does pass up the death benefit, but you tell me, what would you rather have? Something that's going to give you a 3x multiple that works its way and it still keeps up and is a far better deal all the way through your 90s or into your 90s. And then finally, maybe the Roth would have passed up if it had all of this growth that we've projected here. Or would you rather have something like the bird in the hand, which is from day one, you've got a multiple, and this money is for legacy anyway, so we're not worried about cash value. We're not worried about anything that's going on. All that we're concerned about is when I pass away, what is going to give my heirs the highest amount of after-tax wealth? And this is where life insurance just kills it. All right. Even if later on it passes it by a few years. And oh, by the way, if you use that survivorship, don't even have to have that conversation. It wins every year, regardless, because you're getting even more. Or that's not survivorship. That's survivorship and doing the life pay option, right? So to me, this is just a great way to have this conversation with your clients, which is, we've got this tax-free money and it's going to the kids or it's going to our heirs. Let's use the vehicle that was built to do it. Now, The way that we're going to show you how to execute this, I mentioned we've been in the factory a while here, and we built out this Legacy Done Right sales process guide. Now, this is an advisor-facing document. It's meant to be kind of a cookbook for you on how to go about this process, because conceptually it's very simple, right? You got the IRA, take a portion of it, send it to the IRS, the rest goes to the life insurance company. That is a very simple concept. But think about all of the variables that come into play with that just by looking at how much money should go to each. You got to look at their current tax situation. You got to look at where their taxes might be in retirement. You have to look at the heirs tax rate, legacy money. What's the most important tax rate? The heirs tax rate. What's that going to be? Right? What about, and then you have to look at IRMA, and we have to look at then taxes changing. When do we think tax policy could change? What's it look like if taxes? All of these variables come into play. And you might be thinking, Neil, you're way overthinking this. But see, the one thing I don't want to happen in this strategy, if I told my client I can turn $500,000 into $1 million to the heirs, I don't want my client to have to come back 10 years down the road say, you know what, that premium that we talked about, your taxes are more, so we're going to have to come up with more to cover that. I'd rather build that into the budget up front, anticipate what could go on here, and make sure that we can be more precise. Now, granted, this is all based on assumptions, but let's at least get more precise in how we're budgeting up front. It's going to win you business. If you have someone that says, well, your effective tax rate's 20%, let's just go and we'll put 80% into the life, 20%. If we have one person saying that, and we have another person saying, well, based on your very specific calculations of how old you are and whether you're paying IRMA, we're looking at a 22.5%, right? Like it only varies a little, but the precision there can really be what helps win you the business because you know what's going on. So here's the process guide. What we do is we break it down into steps. Obviously, for early steps are just identifying where those legacy funds are. And we've got some documents that you can use that you can incorporate into your onboarding process or into your sales process with your clients on capturing, how to do a risk analysis or risk assessment, ask some questions to identify what those legacy funds are within their IRA. And then we're going to use that Roth Done Right software to help calculate the impact of the IRA money on their tax situation and IRMA situation. And then we're going to introduce life insurance, both from a sales perspective and then also from a structure perspective on how to exactly, find the ultimate way based on those client specific needs, the right way to fund it. Do we go 5-pay? Do we go 10-pay? Do we go life pay? Right? All of that is broken down in this document for you. I'll just kind of, looking at through the lens of the document now. We mentioned those three different types of structure, right? We start with the life pay, and then the 5-pay, and then the 10-pay. Let's spend a little bit more time on each one of those. Like, why would you want to do a life pay? Well, the life pay, as you saw in the example, it's going to maximize the legacy value in many cases. The illustration you get from a life pay that's funded by a guaranteed income rider is going to be higher in general than the 5-pay or 10-pay. Now, what it also means is that your client is paying taxes longer. So they might actually pay a little more tax, a little more IRMA over their lifetime. But if you're looking at net, right, like how do we deliver the most after tax wealth, the life pay can be that option. If we want to go 5-pay or 10-pay, that's a little more simple, but we still need to add some precision to that. So remember, with the life pay, let's just kind of rehash here, right? How are we doing that? Well, we're buying a guaranteed income rider, buying an annuity with a guaranteed income rider, and we're going to fund the FIA with all of the money that's in that we're considering for conversion. So it's a $500,000 conversion. It's all going into the annuity. And then over time, every time we're going to trigger that rider, and the life policy portion of it goes to life policy, a portion of it goes to the IRS. We're going to trigger that rider in year one. Now, your plan is going to vary based on if you're using, I know different annuity contracts, some of them allow you to trigger that rider right away. Others, you might have to wait a year to trigger the rider. And so if that's the case, we've accounted for that in the process guide. You just kind of look through it and we'll show you how to calculate it based on which path you're taking. And then we're going to calculate the withholding amount, really, because what we're doing here really is withholding, right? So once we trigger that rider, when the payment comes out, what do I want to set my withholding percentage at to make sure that we have enough to account for both taxes and any additional IRMA surcharges? And then, of course, the balance goes to the life insurance premium. Now, the tricky part of this is the calculate taxes and IRMA, and that's why this comes up to me. Like I said, a lot of people have been doing this for years and years and years. But most people that I talk to that have been doing it, they take a more broad approach. Like they just look at what their client's effective tax rate is and say, okay, if it's about 20, then we'll just do the 80-20 route, and that's what goes to the life insurance. Well, now with the Roth done right, you have the opportunity to be a lot more precise. So run that analysis. In the life pay option, you're actually going to go to the tabular data, and that's going to give you the year by year. And this is all broken down in the document here. It's going to give you the year by year effective tax rate of what that would look like so that you can properly budget. So then you can run your FIA illustration. It'll tell you how much money you're working with each year. And then, of course, based on the average effective tax rate over your client's lifetime, you can then budget how much of that's going into the life illustration. Follow me? Awesome. Is there a level of confusion? That's okay too. That's why we need the sales guide, right? Okay, what about the 5-pay? That is a little bit more simple approach, right? You just got your tax and IRMA budget, you got your life insurance policy. It is, though, still important to use the Roth done right to calculate the tax and IRMA. You're going to use that page I showed you before. And then, of course, you know, whatever that is, whether it's, you know, for 5-pay, you're just going to take that amount, divide it by 5, and that's how much goes to the tax and IRMA. The balance of it obviously goes to the life insurance policy. Let's spend a few more minutes on the 10-pay because this is probably new for a lot of you. Even the people that I've talked to that are already doing the 10% free annuities to fund the life, they're not really, I haven't heard someone talk about expanding the pay, like the payment period, because of the interest. And this is what allows you to buy some more death benefits. So I really like this 10-pay plus concept here. And that's where you've got the FIA, you buy that with the amount. We're pulling out our 10% free withdrawals. And then again, we're going to use the Roth Done Right software to tell us how much of that needs to go to the life insurance versus how much of it goes to tax and IRMA. And we run, I think it's good to run a 10-pay life illustration to set the foundation. But then, and also, and I'm going to show you a chart in a minute here to tell you how you can expand it. But there also is, it's not just as simple as, hey, take your conversion amount and then starting, you know, put it in an annuity and then pull your 10% free and go. There are a lot of the FIAs that won't allow you to take that first year 10%. Right? You got to wait till you have a year. Well, you're going to need to fund the life policy right away to get it started. So in that case, if you're talking 500,000, maybe the first payment is paid by the IRA itself, and then you put the balance into the annuity, right? Like that sounds pretty easy. Oh, wait, but that means that 10% of the new balance is a little bit less. How does that come into play? Don't worry. I know it's a level of complication, but that's okay. That's what the sales guide goes into, and it shows you, okay, whatever your amount is, if that annuity does not allow you to take the 10% free right away, we'll tell you exactly how much you can put in to withhold and use for the first year life insurance policy premium and taxes, and the balance of it goes into the FIA, where then in years 2 through 10, you can then take and fund it. We'll tell you exactly what those calculations are in the document. Now, the plus idea, right? Like, as I mentioned, you've got interest. And I think in the example that I had, I assumed a 5% growth rate. So that gave me 4 additional premium years. And so, and this is in the, you know, the 10-pay idea, the original annuity, whether it's a MIGA or an FIA, what is the earnings rate on it? And based on what the earnings rate is, it'll tell you how many additional years you could buy if you wanted to. So if you have, pick a number, 3.5% growth rate from the FIA, well, 3.5% means that you can turn your 10-pay into a 13-pay, right? This is not the rocket science part of this. We've already done the math for you, and this chart is in that sales guide, so we can make it simple for you. Okay. How you feeling? Are you feeling good about this? I I have talked to advisors. I've talked to the IMO community, the carriers. Legacy at using IRA money to fund life insurance is hotter than it's ever been. And so we're excited to be a part of that and give you a nice step-by-step kind of, like a guide on how to walk through it. And so this is available to all of our members. So in your Premium Plus account, you can go to it. If you have Premium Plus, you already have access to the Roth Done Right software. There's a landing page that we've built where you can go. It's going to put all of this for you. It'll have a replay of this recording. So if you'd like to go back and watch this again, it'll be on that. And of course, like always, we expect you to spend time with us. And so that is Alex coaching scheduling link on that QR code. So just go ahead and click that or take a picture of it or whatever, and that'll take you to Alex calendar. If you want to spend some time with me, I've been doing more and more of this as well. My calendar link is in there somewhere. I might have to look a little harder to find it, but you can. I'd love to spend time with you because there's nothing that I enjoy more than people calling me up and walking through a case, and then they go and close that business. And the thank yous we get on the back end of that, it can make your year. It really can. Just one of these cases can really change a practice. And so I'm excited to see this used. And so thank you so much for being a Stonewood member. And thank you for your time today. I know this one was a little bit of a longer one, but I think it was important to cover all of this. And go in and download the sales process guide. I want to see a bunch of downloads on that today because I want to see you all using that and using it to close business and then calling us and telling us about it. Thank you so much. Have a great day.